The West Asia war correction of March and April 2026 has washed through the Indian equity market and prices have bottomed. For investors, the calculation has shifted. The question is no longer whether to deploy capital, but exactly how to position it. Historically, capital in this recovery phase splits into two distinct channels: quality and momentum. Competing for before one inevitably overtakes the other. This chart tracks the divergence in terminal wealth between those two factors. 1,000 rupees invested in the quality index in April 2005 grew to just under 20,000. That exact same 1,000 rupees invested in momentum grew to over 30,000, a massive 48% gap in final value. What makes that gap counterintuitive is the risk profile. Both factors carry an identical Sharpe ratio of roughly 0.85. Momentum does experience larger maximum drawdowns, so it requires a stomach for volatility. But over a full cycle, it delivers a materially higher absolute return for that exact same unit of risk. If the statistical risk is identical, accepting a 48% deficit in terminal wealth means hiding in quality over a full cycle is mathematically suboptimal. To understand why that gap exists, we have to break the continuous 21-year timeline down into distinct market regimes. Specifically, the six major upcycles since 2005. Momentum outperformed quality in 5 of 6 major bull runs. Quality's defense averages roughly 6 percentage points of outperformance during bear markets. In contrast, momentum's return during those 5 winning bull runs is 67 percentage points. Bull years occur far more frequently and last significantly longer than bear years. That mathematical asymmetry forces the massive upside outperformance to aggressively compound over the long term. Investors who rotate into quality are sacrificing 67 points of upside to secure 6 points of downside protection. Ultimately, it is a highly irrational trade-off. There is one glaring exception in the data. The single upcycle where quality actually beat momentum was the 2009-2010 recovery following the global financial crisis. That specific financial crisis was defined by highly leveraged corporate infrastructure that collapsed inward under its own massive weight. Going into 2008, the momentum index was heavily concentrated in infrastructure, metals, and real estate. Those sectors faced a structural impairment and required a slow, multi-year credit clearing process. The 2026 environment shares none of those traits. The recent drop was a clean valuation reset triggered by a geopolitical shock, completely lacking in financial system stress. This chart shows a reduction in systemic leverage. Small cap net debt to equity in India has fallen from a stretched 1.56 times in FY14 down to a historically clean 0.35 times today. The accurate historical analogs for today are the 2016 demonetization shock and the 2023 FII outflow correction, both periods of disruption without systemic leverage issues. During both of those recovery phases, momentum blasted past quality by an excess of 50 percentage points. Positioning in quality right now relies on the assumption that we are facing a 2008 style systemic credit crisis rather than a standard expected cyclical recovery. To see exactly how these factors are positioned, we have to look inside the indices themselves. Right now, they share almost zero overlap. Only 3 out of 30 stocks appear in both. The current momentum index is a pure domestic cyclical portfolio. Half of its weight is concentrated in financial services, heavily geared for net interest margin expansion as credit growth resumes. It follows that up with a 13% allocation in automobiles, positioned perfectly to capture reviving rural construction and premiumization. Another 7% sits in aviation and services, targeting Indians' rapidly expanding underpenetrated travel market. The quality index, meanwhile, operates as a defensive compounder portfolio. By accident of its own screening rules, it is currently massively overweight in the exact sectors facing secular headwinds. It carries a 27% exposure to information technology, a sector struggling with US client budget pressures and structural disruption from AI. Another 20% is locked in FMCG companies, suffering sub 3% volume growth as rural consumers increasingly bypass traditional staples in favor of aspirational credit and mobility. The quality label is currently acting as a disguise for a basket of companies facing severe cyclical drag, while momentum provides direct, unhedged alignment with India's domestic earnings recovery. This theoretical macro shift is already executing in live market mechanics, and the rotation is violently reversing direction. Calendar year 2025 played out exactly as historical modeling dictated. It was a consolidation phase where quality steadily compounded while momentum whipsawed and underperformed. But CY26 year to date data shows a sharp 500 basis point swing. Even through the West Asia War's market drop, momentum strongly outperformed quality. Historically, a rolling 3-month reversal of this magnitude following quality leadership triggers a confirmed regime shift. This historical persistence dictates that the current trajectory of momentum outperformance will likely lock in for the next 12 to 24 months. The market has already digested the geopolitical shock. Institutional capital is actively rotating into the momentum trade right now, and the window for early reallocation is rapidly closing. The empirical data heavily favors momentum, but the trade is not unconditional. It relies on specific macroeconomic variables holding steady. This risk matrix maps the potential threats. The primary high probability risk is earnings. If the upcoming Q4 season reveals a second consecutive year of single digit EPS growth, the broader market consolidation will extend, likely returning leadership to quality. There are also medium probability risks. A sudden AI driven revenue inflection could uniquely save the IT sector, or sustained 90 plus oil prices could choke out the domestic credit and consumption that momentum relies on. Finally, an unexpected global credit event or financial system shock would severely damage momentum's 50% weighting in financial services, though the probability of this remains strictly low. But absent a black swan systemic breakdown, the math remains rigid. Quality's 6% downside protection is statistically insignificant when weighed against momentum's 67% upcycle outperformance. With clean corporate balance sheets, perfect macro sector alignment, and 21 years of cycle evidence, momentum is the only logical positioning strategy for the 2026 recovery.